Okay, today is September the 5th, 9 o'clock. We're going to get going. I'm planning on doing an executive summary, about 5 minutes in duration, Q&A, so keep track of your slide numbers, which are down here in the lower right-hand corner. And then I'll get into the details of the weekly information, a little more interactive, and then finally some preliminary data for the month of August. You can see the map of Silicon Valley. Santa Clara County is basically in a seller's marketplace except for the Palo Alto, Los Altos area, which is in a balanced marketplace. You flip over to San Mateo County, and the expensive areas, Atherton, Menlo Park, are in a buyer's marketplace. The balance of San Mateo County is in a seller's marketplace. Looking at days unsold inventory, the single number one important criteria, in my opinion, because it's the supply-demand ratio. And what you have is the blue line, which is the raw data for the week. This is when shelter in place was announced. It went way up, which is bad. Days of unsold inventory is one of the few numbers you want it to be as low as possible. And now you can see the blue is below the gold. The gold is the last 5-year median. So that's 2019, 18, 17, 16, and 15. The median of those 5 years, which were all 5 good years, is the gold line. The current data, being the blue, is below that, which means the red line, which is the ratio between the two, is below 100%. And again, most things up and to the right is good. Days of unsold inventory, the lower the number, the faster the marketplace is, which is good for appreciation, lousy for buyers. This is looking at each one of the components on a percentage basis. So now I took those red lines and put them all in one graph. So if you look at the blue line, and the blue line is the available inventory. And so you can basically see we've been flowing right around 100%, even through shelter in place. Yes, there was a little disruption, but it came back up, and part of that was the buyers went away, but so did a lot of sellers. So the inventory that's been available is basically at normal levels. Number of new listings, that's the new inventory coming on the market. Now you can see this huge spike up, and that's because you have to look at the calendar. Labor Day is as late as it possibly can be. So in a lot of years, in the 5 years that I used for my median, Labor Day was actually in week number 34. This year, it's in week number 35. And so last week, you normally have less listings because of the holiday. We didn't really have the holiday, and also holidays are impacting real estate a lot less with shelter in place. And so you had a lot more new inventory coming on compared to normal. That doesn't scare me at all, because normally it's a dip in the number of new inventory coming on. So we just didn't have that dip. Then if you look at the gray line, it's the number of new offers. And that's actually pretty encouraging, because you can see the gray line's been up here above 100%. And just a week after you had the big spike in new supply, you had a big spike in new offers. So that means that the buyers are out there to absorb the new listings that are coming on the marketplace. Then you have the number of new closings in yellow, and you can see that we've been basically above the red line. So we're closing more transactions than we did in 5 great years. So we really can't complain. That's also part of the reason why my initial estimate of the loss because of COVID-19 was way on the high side. The last week or two before last week, so the last 3 weeks now, we've actually been selling more inventory than normal, closing more inventory than normal. So that's me eating into some of that $4 billion loss that we had. Finally, the new cancellations is really pretty minor. You can see it's been basically right at 100%, a little bit below here, and then a little bit above here. The numbers are really small, so even if it's above by a percentage, it really doesn't matter. Then we're looking at the overbidding, 2 different types of overbidding. One is the frequency of overbidding. That's this lower line here. It's in the red area, so that's in what I consider to be a seller's marketplace. And it's basically somewhere around 57%. So that means 57% of the sellers are getting more than their asking price. You'll notice that last week it was a little bit higher, maybe 58%. This horizontal line here is 60. The dividing line where I define going into a seller's market is at 50, but it's not a turn on the switch. You know, basically in this area where you're just below 50, but very close, most people would have perceived it to be a seller's marketplace. It was clearly more of a seller's marketplace than a buyer's marketplace. You have to get down to 30 in order to be into buyer's marketplace according to my definitions. The other one is the magnitude of overbidding. How much are buyers overbidding sellers? And you can see we're basically right about 102%. There I define anything above 101% to be a seller's marketplace. Yes, a lot of people would say anything even 100% should be a seller's marketplace. I actually think it has to be a little bit higher because a fair number of agents price properties a little bit low, trying to trigger in those multiple offers. This is a different graph than from what most people show. And what this is doing is it's showing the overbid price distribution for the different weeks. So the current week is the red bold line through here. That's pretty hard to see because it's on top of so many other lines, but you can sort of see it tracing, then horizontal, then it dips down over through here. So that one solid red line is the current week. All these other weeks are going back, and we go back as far as April 24th. The more recent past weeks are in solid lines. The next group of weeks back is in dashed lines. And finally, you got dotted lines, which are the oldest weeks. So when you look at this, it's actually doing pretty well. There's a few dotted lines up here that are doing better. And if you go back and look at it, it's hard to really pick out. But you're dotted and you're blue. So I think that's May 15th of this year. And then dotted gold, which appears to probably be, I guess it would have to be April 24th of 2020. But other than that, it's basically right in there or better. It's better than a lot of the weeks we had back in July and June, which are the dashed lines. You can see all the dashed lines are down here below. So each week is going to be one line, and as you jump between lines, you're jumping between weeks. And basically, as you go up and to the right between lines, you get to be a better marketplace. These outlying lines are the best September we ever had, which was September of 2017, and the best month we ever had, which was April of 2018. Similarly, on the downside, the blue line, the first blue line, is the worst September, which was September of 2001. And the second one is the worst month ever, which was December of 2001. And so basically the takeaway here is you're sort of in the middle of your range. You're better than you have been recently. So the market overall is improving. This slide here now just tries to make it a little easier, where I now only go back to June 16th. And you basically can see it's at or near the top of all the weeks since June 16th, with the dotted lines basically being lower here, which are the oldest, the dashed lines being close, and the solids are being real close. So basically it says the market's improved and staying pretty well improved. And again, this is the reason I put this in here, is this shows the amount of pressure the buyer feels. If the buyer's not feeling any pressure, he's not going to pay more than the seller's asking. Now, just to give an oversight, I'm looking at the single biggest micro market I use, which is single family homes in Santa Clara County. And the red line here is the demand for offers, or a number of offers, so it's the demand curve. The blue line is the supply, the amount of inventory. And in a nutshell, what happens is when the red is above the blue, you're into a hot marketplace. So just before shelter in place, you can see the market was on fire. Shelter in place was basically announced. We went into, inventory being above offers, which is a cool marketplace, and that's exactly what happened. Once we could start showing occupied properties, I think on May 1st, we rapidly came up, and now we're back into a seller's marketplace. Now remember, this is micro market data, so I use 5 weeks for Santa Clara County single family, and that's why the delay from May 1st to basically June 12th is you had to get 5 weeks of data to compare to past years where there wasn't the disruption in the marketplace. Now, this is looking at the blue line, is days unsold inventory that we looked at already on the week basis. But on the week basis, that's the macro data. So that was looking at condos, townhouses, single family homes in both counties. This is looking at the same metrics, but only single family homes in Santa Clara County. So you can see as a shelter in place was announced, it went up. Then it started improving as we could start showing vacant properties, started really rapidly improving as we could show occupied properties. And you're basically down here, you're flat, you're going down a little bit. Down again is an improving marketplace, a faster and faster marketplace. You're under 30 days, which is pretty incredible. I think the number is somewhere around 27 and a half days of unsold inventory, which would basically mean we would sell all of the existing inventory in 27 days. Now, the future line is something that more people quote, which is median days on market. And actually, the yellow line is what most people quote, which is average days on the market. So right now, we have an average days on the market of 20. So the average seller is going to be on for 20. but 50% of the sellers are selling in 10 days or less. And frankly, when you're looking at a 10-day for half the sellers to sell, what you're doing is you're selling those properties as soon as the seller will look at an offer. Because in all honesty, you get a listing, you want to expose it, you want to get through a week on the marketplace, then you have to then get an offer in there. There might be technical things to counter, so it takes a couple of days. So anytime there's an offer accepted in 10 days, that's probably as soon as the seller would accept it. So very strong marketplace on all three indicators. Now you look at what's happening with price. Most people quote the median price, which is this middle. You can see we had a nice run up at the beginning part of the year before shelter in place was announced. Because this is sale price, there's basically a 30-day lag, and then I'm using 5 weeks, so there's close to a 9-week, 10-week lag in the data. And basically you can see prices are flat. They're clearly not going down. What I also add to the data set is the 10 percentile. What is the bottom part of the marketplace doing? And what is the top of the marketplace doing, the 90 percentile? So 80% of the homes are between these two numbers, which are somewhere around $850,000 and $3 million. And the median is at 1.4. I think it's 1.407 or something of that order. This again is looking at the frequency and magnitude of overbidding. And again, instead of looking at just 1 week macro data, this is looking at 5-week micro data. You can see we went way up early in the year before shelter in place. And again, this needs sale price, so it's lags. And then it dropped down during shelter in place. And once we could see properties, it came back up. It hasn't come back up to this level that we were at before, but you still have 60%. So 6 out of 10 sellers are getting more than their asking price, which is pretty significant. And I changed the color of this graph up here, which is the magnitude of overbidding, to green, just so that we can try to see it a little bit as it goes through this red line. Because when it was red on red, you couldn't see the actual data place. So now it's green on red, so you can see the data go through there a little bit better. And one of my observations is anytime the market gets shooken up, it is more restraint on how much overbidding people do, not on frequency, but in magnitude. So that's why we're sitting here at somewhere around 102%, where earlier this year we were at 106%. I would expect the number to be around 105%, but all the buyers are saying, hey, the market could turn down. They're more hesitant to overbid. And this is the graph that I showed last week. I'll probably take it off, but this is how I calculated that we lost $4 billion of transactions because of shelter in place. I basically looked at the 5 years of data, came up with a median. Then I looked at 2000 and 2020 data. How many transactions did we lose? The number of transactions, the average dollar amount instead of median, and that's the correct metric to use for this calculation. And then the gross value lost for each kind of property. So you can see Santa Clara County accounts for basically 2.8 billion out of the 4 billion. And the bulk of it is in single family homes, in part because the price is a lot more expensive. If you look at the percentage, the biggest drop was condos in Santa Clara County, which actually is a little surprise for me. I was expecting it to be condos in San Mateo County, which finished second. Wraps up my rapid executive summary for people, and I'll entertain questions. This is my base URL. You add in 2020, the date code 2020-0905, and that will get you to the archive of this particular presentation. The handout is posted. I was a little bit late. I think I got it up there at 8:58. So you use the base URL, then handout singular, and today's date to get it. It's about 110 PowerPoint slides. And then future Zoom meetings are just at the teeny URL, root URL plus 2020. So now what we're looking at is the weekly data. And this is important because this is what the market's doing. And this is not going to duplicate what we saw in the executive summary. What you're looking at here is the active inventory without offers. And you can see, again, the blue line is the raw data. The gold line is the 5-year metric. And you can see the red line is saying we're right on top of 100%. So we're having a completely normal year. Yeah, and you can see the dip normal for July 4th. You can see the dip normal for Labor Day. And this year we're not having the dips because people aren't really going on vacations because of shelter in place. Moving on to the number of new listings. Here you can see because of the holiday last week for most of the years, We were way up last week, but now we're right back to normal. You can see normally it dips down as far as quantity based, and this is July 4th again. This is Labor Day. We're not going to have much of it dip down. And at this point, I would expect us to continue following the gold line. And I would suspect that this is Thanksgiving dip here, and then this is the Christmas dip. So you can really see the impact of holidays on real estate. Now we're looking at the number of new offers accepted in the past week. And again, this is macro data, Santa Clara County, San Mateo County, single family, condo, and townhouse, but for 1 week only, which is why there's so much bounce. But I want to be able to see any trend shifting. And same concept, the blue line is the raw data. It's above the gold, and that's good. That means you're selling more offers, you're getting more offers accepted than you typically have, and that's why the red line is above the 100% horizontal red line. Moving on, looking at the number of closings, and for a long time, this was actually puzzling me, and this line was down around 80%. And finally, it dawned on me why it was at 80% instead of where the data is now and how I got the data where it is. My 5-year median data is all historical data. My current data is looking this week at reports. So if I'm reporting data through 11:59 on Friday night, getting the data on Saturday morning, a lot of those escrows that just closed haven't been reported. I was missing about 19% of closed transactions. So what I'm doing now is I saw the numbers 19%. The current week data is multiplied by 19%. So this is inflated, but the 1 week back is not inflated. It's using the raw data that's a week old. And I'm going back and updating it for a total of 3 weeks. So this is 1 week, next week is 2 weeks, and then one more week to stabilize it. So the data from this point back is 100% accurate. This week is inflated by 19%, which is about what I expect the late reports of close of escrows to be. And that was why the number of offers going into escrow was normal, and the closings were low, as I was missing some of the transactions. It turns out that agents are way better at reporting offers accepted. There's only a 6% missing, and I've corrected that data as well. Moving on to expired listings, you can see the raw data were slightly above the gold, the historical data, and you can see that in the percentage. And again, this doesn't alarm me at all. This is not inconsistent with the market being on fire. This is consistent with all the withdrawn listings back here now reaching their expiration date and showing as new expired listings. Canceled listings. Canceled listings are actually been basically right at the gold line. And, you can see recently they may be a little bit above, and basically that's showing up here in the percentage. We have exactly the right number of cancellations on a weekly basis. Now, withdrawn listings, you'll notice that there's no red lines and no historical. And that's because of the problem of once the expiration date arrives on a withdrawn listing, the MLS now counts that as a withdrawn listing and as a expired listing and treats it as an expired listing. So there are no withdrawn listings historically. And so all you have is a raw count. And again, you come over here and say you're somewhere under 30 or right around 30, and you're looking at 2 counties and 3 types of properties, and that's just a drop in the bucket. Putting magnitude on it, there's roughly 2,300 listings. And out of 2,300 listings, 30 are being withdrawn. That's really not going to shift up the marketplace. Now we're looking at overbidding, and we're looking at overbidding on the macro data. This is going to be single-family homes. The different maps are showing in the different geographical areas. We drop back for 5 weeks. It's 29 days. It's 5 Saturdays. And so here's the 15th. You can see how hot the market heated up. And now I added in the shorter lines around the balanced market areas that were missing. And you can see Saratoga went balanced. Now it's back to hot. And this is the current data. So basically, this is going to be on closings because it's based on overbidding. All of Santa Clara County is basically in a seller's marketplace, except the peninsula up here, the Palo Alto, Los Altos areas is in a neutral marketplace. You go into San Mateo County, it's a little more balanced. Redwood City is a balance. The north is a balance, but all your base cities and your coast are in a seller's marketplace as far as overbidding. Now we're going to look at days on sold inventory, the same thing. We're going back to August the 8th, and then we're going to step forward week by week. Red being hot, this gray color being a balanced marketplace, and you'll see the borders added in there. So the shift here was up here in the North County became a balanced marketplace. And here's the current one. You can see the North County and San Mateo went back to sellers. This actually went from a balanced marketplace to a buyer's marketplace. The bulk of San Mateo County is in a seller's marketplace. This table is an overview. I'm looking at each one of the different geographical areas by type of property. I'm looking at before shelter in place, then I'm looking at the current data, and then I'm looking at whether the change between the two favors the seller. So in the first column, you basically can see red indicates that that market was in a seller's marketplace before shelter in place. You can see we had a couple that were in a balanced marketplace. And just for noteworthiness, 149.7, I mean, at 150, that would have gone actually into a buyer's marketplace, but you draw the line somewhere. And so it was red hot before, it's red hot after shelter in place. And if you look at it, there's more in the single family homes, there's more favoring the seller than the buyer. So to favor the seller, that means it's further into a seller's marketplace. So you went from 32 days to 29 days. So that's fewer days, which means the market's faster. There are some areas like Palo Alto, Los Altos that have shifted into a buyer's marketplace. Same concept in overbidding. And this is going to be the frequency of overbidding, the magnitude of overbidding, and then price. And the reason these are all white is price by itself doesn't have a buyer's or a seller's marketplace, but the trend from the first point to the, before shelter in place to current does have a trend, and you can see that for the vast majority of them, it's favoring the seller. Now we're going to go into 11 different metrics, 5 different slides on each metric. We're only going to probably look at 2 slides and only discuss 1 slide for each metric. So the first one is days unsold inventory, and this is why we're not going to discuss this slide. It basically is hard to pick out where the data point goes. Here you can see it. It's the 3 biggest micro markets, and that being Santa Clara County single family homes in red, San Mateo County single family homes in gray, and condo townhouses in Santa Clara County in yellow. And the big takeaway, in my opinion, here is if you go before shelter in place, condos were in the hottest marketplace because this is days unsold inventory. So a low days unsold inventory is a hot marketplace. Coming out of shelter in place, it's the highest. So it's been impacted pretty significantly. If you look at single family homes for Santa Clara County in the red, it's basically the same level before and after. If you look at single family homes in San Mateo County, it's the same level essentially before and after. So those markets have come out unscathed. The condo townhouse market has been hit pretty hard. I will just point out that I believe part of what's happening is the consumers are saying, hey, if I'm going to have to work at home, I need a little bit bigger place. I can't have the neighbor next door making noise when I'm trying to work. I need to spend the money to get a single family home. The other trend that is noteworthy is further away areas like Morgan Hill, Gilroy, South County have been on fire compared to the rest of the county. So people are now willing to commute further because they're not commuting in every day. And when they do have to commute in, the traffic is less. Now we're looking at days on market, which is very similar, just a more common number. This is not an improving market. This was the MLS freezing the data. They were no longer counting days on the marketplace. And so the data all went to 0, which means more than half the homes were selling during shelter in place, were listed during shelter in place. So we were listing and selling homes during shelter in place. Now you can see we're back up and the data is basically pretty stable, which indicates you have a stable marketplace. It's not accelerating. It's not getting slowing. Now we're looking at inventory. We're going to discuss inventory on this slide because the 3 county data pulls itself away from the pack. So these are all my different micro market areas. And it is interesting, when I set up these micro market areas back in '97, I was trying to get 200 listings in every one of them. And you can see I now fall short. And that's because we're selling a lot less homes than we used to sell. But I still feel comfortable with micro market areas. It just makes the data a little more fluctuating. But you can see with single family homes in Santa Clara County, the available inventory basically peaked somewhere, right in here, type time frame. It really hasn't dropped off. Normally it peaks around July 19th, which is right about here, and drops off a little more significantly. I think that may just be a impact of shelter in place. You can see the condos have continued to go up, and you can see single family homes in San Mateo County have continued to go up. So Santa Clara County is acting a little bit more normal than the other markets. Now we're looking at the number of offers accepted. And the number of offers accepted normally peak basically on the Friday before Memorial Day. So that's basically way back here at the end of May. So this is normally your peak of the number of offers. Well, we were just still coming out of shelter in place. May 1st was, I believe, when we could start showing hot properties, a 5-week lag time and a 4-week close time. It's just up here. But right now, instead of this number of offers dropping off, it really isn't dropping off. So this is where we're picking up a few of those transactions that we missed up here. Not nearly as many as we missed, but the fact that it's not dropping off is we're picking up a few extra transactions. Now we look at the number of closed transactions, same pattern as the number of offers. We're looking at overbid frequency. You can see that we're up here at 70% for Santa Clara County in the red line. Now we're only at 60%, but you can't complain. Six out of 10 sellers are getting more than their asking price. This is the magnitude of overbidding. This has dropped down quite a bit, which is what I would have expected. You were up here close to 105.5%, San Mateo County at 106. Now you're down here at basically 102%, 102.5% maybe. It's just every time the market gets hit with something, buyers are more conservative with the amount of overbidding. Now we're looking at price. This is the cheapest 10% in all the areas. And this is so you can see if there's one part of the marketplace that's getting impacted more than the other. And basically prices are flat to slightly increasing. Moving on to the 50 percentile, the median, which is what most people follow, like Santa Clara County. I mean, you were at 1.4 million, basically right there, dipped down a little bit, came back up a little bit, up and down. And I think we're at 1.407 right now. So prices are basically stable. Anyone that thought prices would plummet with shelter in place is mistaken. And now we go on to the 90 percentile, and this is what the top end of the market's doing. The top end of the market, especially in San Mateo County, is a little more volatile. Prices are a little bit higher. There's a little bit fewer properties. It just bounces around a little bit more. That's why I used 90 percentile. If I went 95, this data would become almost unusable. If I go 85 and then 15%, then I only have 70% of the homes between the 90 percentile and the 10%. I wanted as much as possible, so I sort of pushed the envelope. Santa Clara County, pretty stable. Moving on to duration of escrow. This is how long it takes to close escrow. It's no real big deal, but it is a little bit slower. This was before shelter in place. San Mateo County at 25 days, now at 28 days. Santa Clara County was at 27 days, now at 30. Condo townhouses was at 28 days, maybe 29 days, now at 30. So just a little bit longer, no big deal. Here's the actual data if you wanted to look at any data point. Here is the table going back for 20 years, so you can compare right now to the past years on how we're doing. Just a word of warning, this data is tentative. It will change next week when I have the final data, and that's just because, there's 20% of the closings in the last week that aren't there. And I'll just leave this slide up there. So if you want to get the handouts, here is the URL for the handout. It's my root URL plus the word handout 2020-0905. Future presentations back here. Anyone want to unmute themselves and ask a question? Now we're going to look at monthly data. Now again, this is preliminary monthly data. It is going to change, and I will report the updated data next week. But here we're looking at the semi-log price of the different things. This is your 10 percentile, median 50 percentile, and 90 percentile up here. The slope of the line tells you the rate of appreciation. So long term, you can see the appreciation has been up here. 19 was a pretty flat year of appreciation. 2020 is pretty flat, but at a higher level. So you basically had the appreciation at the beginning part of the year, but we've been basically flat. And the top does a little more fluctuation. It's almost like the increase at the first of the year was delayed for the high end. Here is the normal plotting of that data that you're more used to seeing, where you have the normal scale for pricing. Here is the sale price to list price, the frequency and magnitude of overbidding. So here you can see historically what's happened for the frequency of overbidding. And you can see the impact of shelter in place and the fact that we're coming back up. You normally have this sort of half sine wave, upside down sine wave every year. And you can see there's different years that have had different impacts. 17 was the first really shakeup where we had 2 years of appreciation. And then in the latter part of 18, we sort of had a payback for that second year. 19 was pretty flat, and then 20 is there. So, we're not at record levels, but we're not doing badly. And then you can see the magnitude of overbidding. It was higher in past years than it is right now. It's lower right now than you'd expect, but that's because we've had a recent insult to the marketplace. This is a nod to the advanced decline ratio of the stock market. That is done on a unit basis, is my understanding. This is just a ratio for a given month, straight line back. Ignore that. That's just a little trick that I learned to get it so I don't have to do as much labor. So that line will stay there, but it allows me to add in data points without having to redrawing the graphs. This is days months sold inventory, the most important single indicator. This is on a monthly basis. You can see we're down here in a seller's marketplace. Then you have median days on market in the fuchsia, average days on market here in the yellow. The dip down here is artificially low. And again, that's because the MLS was not counting days on market during shelter in place. Here's where I do a 12-month moving average. So I look at data for August, which is data from, then I look at data for July, and I go all the way back to last September and I plot it out. But I plot the DUI in real time, so you can just see the trend. So inventory has been coming down. It's just, I'm not sure I get anything out of it, but it's there for people that have asked for it. Here is the overbidding, and now we're comparing apples and apples completely, because I didn't mention, I don't think, in the earlier graphs when I did this, the outline, the max and the mins were single family, because that's all the data I have, single family in Santa Clara County historically. But the lines all be in between the week data was the macro data, condos, townhouses, single family homes in both San Mateo County and Santa Clara County. So that was all consistent. It was just the outlying borders that, I have a little question. I also did not have time to investigate this little interesting graph here. It's going to be probably a data point error, but I don't know how it happened. Basically what it's saying here is that here's 2020 compared to all the last 20 years. So you can see that 2020 is worse than most of the years, but noteworthy, 2020 is better than last year. This gold line, solid gold line down here is 2019. It's also better than this line, which I believe is 2014. So it's better than 2 out of the recent 8 years. And so it's worse than 6. But it's really not that much worse. And then it's better than all the years from 2005 through 2012, and better than all the years from 1998 to 2004. So, I don't know how to say this, but we really can't be complaining about the marketplace out there. It would be nice to have more inventory to slow the market down a little bit, if anything. And here you can see the same data point got plotted here incorrectly. Now it's just 4 groups of 4. So the recent ones up here are going to be 17 and 18 were your great years. 19 was a worse year. And then the other good years you can see a little bit better look like to me to be in order 2015, 2013, and 2014. And then I think this is going to be 2016 down here. So just, interesting thing to observe. And then this shows you the price of the top end of the marketplace compared to the median, and the bottom end of the median to the median price. So here where they got closer together, you had what I call price compression. There wasn't as much spread between the top and the bottom of the marketplace. When we had the 2007 meltdown, we started a separation here where prices exploded away a little bit from each other. That's price expansion. And we're in a little bit of price compression, not as much as we were back here, but a little bit of price compression going on. And that wraps up the monthly data. So that is the URLs in case you didn't get them. And I'm going to open it up for questions. And
I think that on the page 106 and 107, the title, I don't quite understand. Why do you want to group in 4 years or 6 or 8 years? See, it says here, past 24 years in groups of 8 years. What's that mean?
If you notice, the first 8 years of the 24 are solid lines.
Okay.
The next group of 8 years are dashed lines, and oldest group of 8 years is dotted lines. And that's just to facilitate when you come over and look at the graph, you can see these dotted lines down here are old years, and you can see these solid lines up here are new years. It just gives you a reference without having to identifying each year.
Oh, okay. Now I can see.
You know, and the groups
Okay.
of four are the exact same concept, but here I did it in groups of 4 years. It just helps you find the data more rapidly.
Okay. So it's basically, it's pretty, there's not that much change within, say, every 4 years or every 8 years. So
It's
because
not,
they group pretty together.
well, they're grouped together here because, well, what I would actually say is there's a big difference between these dotted lines here, 2009 and 2017. There's not much of a line on the graph, but it gives you some idea. 2009 was not a good year. So this tells you that down here is not a very good year. This is a phenomenal year up here, and you're somewhere in between.
Yeah.
The point here is we're not down here. And the surprise to me is seeing where 2019 was. I mean, last year, I didn't hear too many people really complaining about last year, but yet we were having a fairly bad year as far as buyers feeling pressure to overbid.
Okay. Yeah, I see. Still some difference.
There is definitely difference,
Yeah.
And it's hard to explain, but each line is the month, well, here, let's just look at it. Right here, the red line, right now, somewhere around 57% of the sellers are getting their asking price, or, well, I guess it's the reverse way. Yeah, 57% of the sellers are getting their asking price or more. Here, 35% of the sellers are getting 3% above their asking price or more. 15% of the sellers are getting 8% or more above their asking price. So you can see what it means in terms as you go along the line. So when you go from this year to the hot years, you can see that the sellers, 15% of the sellers now are getting 8%, where in 2017 and in 2018, they were getting 15%. So they're only getting half the amount of overbidding they were getting in just a couple of years ago.
Right. Yeah. Good. Thank you.
You're more than welcome. Any other questions, or does that do it for you?